Guangdong's foreign trade reaches record high, insights and analysis. In the first half of 2025, Guangdong achieved a remarkable milestone in its foreign trade, reaching a staggering total of 4.55 trillion yuan. This impressive figure represents a year-on-year growth of 4%, outpacing the national growth rate by 1.1 percentage points. Specifically, exports amounted to 2.89 trillion yuan, reflecting a modest increase of 1.1%, while imports surged by 9.5% to reach 1.66 trillion yuan. Notably, this period marked record highs in the total value of imports, exports, and overall trade for Guangdong. Despite facing a challenging and intricate global trade landscape, Guangdong has demonstrated resilience, maintaining positive growth for 8 consecutive quarters since the third quarter of 2023. In the first half of the year, the province accounted for 20.9% of the nation's total foreign trade, which is an increase of 0.2 percentage points compared to the same period last year. This growth contributed significantly, making up 28% of the national trade expansion, thereby playing a crucial role in bolstering both China's foreign trade and the province's economic development. The diversification of Guangdong's trade partners has also been noteworthy. During the first half of 2025, trade with ASEAN, the province's largest trading partner, grew by 5.9%, reaching 757.13 billion yuan. This accounted for 16.6% of Guangdong's total trade, marking an increase of 0.3 percentage points from the previous year. Additionally, trade with other key partners saw positive trends. Hong Kong SAR increased by 7.9%, the European Union by 7.2%, Taiwan Province of China by an impressive 26.2%, Japan by 8.1%, and South Korea by 7.2%. However, it is worth noting that trade with the United States experienced a decline of 8.1%. Trade with countries involved in the Belt and Road Initiative reached 1.79 trillion yuan, reflecting a growth of 3.8%, which included a remarkable 23.1% increase in trade with the 5 Central Asian nations. A total of 130,000 enterprises in Guangdong reported actual import or export activities during this period, marking a 7.6% increase. Among these, private enterprises accounted for 110,000, which is an increase of 8.6%. Their combined imports and exports reached 2.92 trillion yuan, representing a 4.3% rise and constituting 64.2% of the province's total trade. Furthermore, Guangdong has been proactive in accelerating its industrial transformation and upgrading. Exports of mechanical and electrical products rose by 7.2% to 1.96 trillion yuan, which now represents 67.8% of the province's total exports, an increase of 3.9 percentage points. Key export items such as computers and their components, electrical equipment, and integrated circuits saw significant growth rates of 15.9%, 17.2%, and 27.1%, respectively. Emerging products, including drones, solar batteries, lithium-ion batteries, and electric vehicles, also exhibited robust growth, with increases of 29.2% and 28.8%, respectively. Additionally, exports of cell phone brand products reached 655.27 billion yuan, reflecting an 11.2% increase. This data paints a vivid picture of Guangdong's dynamic trade landscape, showcasing its ability to adapt and thrive in a complex global environment. What do you think about these developments? Do you believe Guangdong's trade growth can continue in the face of global challenges? Share your thoughts in the comments. Unlocking China's FDI potential, opportunities amidst decline. China's foreign investment slump, a hidden gateway to strategic growth in a transforming economy. Bold headline China's foreign direct investment, FDI, is plummeting, but this isn't a sign of collapse, it's a strategic recalibration. And this is the part most people miss. Within this decline lies a golden opportunity for forward-thinking investors. Since 2023, China's FDI inflows have been on a downward spiral, with 2024 marking the sharpest drop ever recorded, a staggering 27.1% year-on-year contraction. By early 2025, the trend persisted, with FDI falling another 10.9% to 320.8 billion renminbi in the first 4 months. While these numbers might seem alarming, they tell a deeper story of structural shifts in policy, sectoral resilience, and a global recalibration of risk. For investors willing to look beyond the headlines, this slump is not a red flag but a green light to engage with a market undergoing profound transformation. But here's where it gets controversial. Is this decline a sign of China's weakening economic prowess, or is it a deliberate pivot toward a more sustainable, innovation-driven model? Let's dive in. Policy reforms, laying the groundwork for resilience. China's government hasn't sat idly by. In response to the FDI decline, it has rolled out a series of targeted reforms aimed at restoring foreign investor confidence. These include expanded market access in high-value sectors like cloud computing, biotechnology, and healthcare. For instance, the revised catalogue of encouraged industries for foreign investment now offers clearer regulatory guidelines, reducing ambiguity for foreign firms. Additionally, the extension of tax holidays until 2027 and incentives for R&D centers underscore China's commitment to fostering innovation-driven growth. One particularly intriguing move is the push to encourage reinvestment of profits earned in China. This isn't just about retaining capital, it's about creating a stickier, more integrated investment ecosystem. These reforms align with China's broader economic strategy, shifting from export-led growth to a model rooted in domestic consumption and technological self-reliance. While regulatory unpredictability remains a concern, recent efforts toward transparency and sector-specific guidance suggest a gradual shift toward a more investor-friendly environment. Sectoral resilience, where opportunity knocks. Despite the overall FDI decline, certain sectors have thrived. High-tech industries, including e-commerce, aerospace, and chemical pharmaceuticals, have seen inflows surge, with growth rates exceeding 50% year-on-year in the first half of 2025. This resilience is driven by China's push for technological sovereignty and global competitiveness. The services sector, particularly finance and logistics, has also emerged as a dominant player, accounting for over 72% of total FDI in early 2025. This sectoral realignment reflects a strategic pivot by both Chinese policymakers and foreign investors. For example, while traditional manufacturing FDI has slowed, investments in electric vehicle (EV) supply chains and advanced manufacturing remain robust. Companies like CATL and BYD are expanding globally, leveraging China's domestic capabilities to scale production and reduce costs. Meanwhile, European firms are increasingly focusing on joint ventures in green technology and digital infrastructure, where China's market size and regulatory support create compelling synergies. Global uncertainties and geopolitical dynamics. China's FDI decline can't be viewed in isolation, it's deeply intertwined with global uncertainties. US-China tensions, tariff threats, and European regulatory scrutiny have heightened risk perceptions. Yet, these challenges also highlight the importance of diversification and long-term positioning. While European firms have scaled back capital commitments, their interest in China's high-tech and services sectors remains strong. In 2025, Japan and the UK saw FDI inflows surge by 70.2% and 60.9%, respectively, reflecting a strategic reallocation of capital toward China's innovation-driven economy. China's role in the Regional Comprehensive Economic Partnership, RCEP, and its deepening ties with ASEAN countries are also creating new investment corridors. These partnerships go beyond trade, focusing on building resilient supply chains and cross-border R&D collaborations. For investors, this means opportunities in sectors like green energy, digital infrastructure, and healthcare, where China's domestic demand and policy support converge. Strategic investment opportunities. For long-term investors, China's evolving FDI landscape presents three key opportunities. 1. High-tech manufacturing. Sectors like EVs, semiconductors, and industrial automation are booming, fueled by domestic demand and government subsidies. Companies with expertise in these areas can capitalize on China's scale and supply chain efficiency. 2. Services and digital platforms. The services sector's dominance in FDI inflows highlights the potential for investments in fintech, logistics, and e-commerce. These industries are supported by China's digital transformation and a growing middle class. 3. Policy-driven sectors. Areas like biotechnology, green energy, and healthcare are being prioritized through tax incentives and regulatory reforms. Long-term investors can ride the wave of these policy tailwinds. However, success requires a nuanced approach. Investors must navigate regulatory complexities, geopolitical risks, and sector-specific challenges. For example, while the EV sector is booming, competition is fierce, and regulatory hurdles for foreign automakers persist. Similarly, the tech sector's rebound hinges on resolving issues related to data governance and intellectual property. Conclusion, seizing the moment. China's FDI decline is not a terminal diagnosis but a symptom of a broader economic transition. The government's reforms, sectoral resilience, and strategic realignment of global capital all point to a market in transformation. For investors, the key lies in identifying sectors and partnerships that align with China's long-term goals, particularly those that benefit from its innovation-driven growth model. While the path ahead is fraught with risks, the current environment offers a rare opportunity to engage with China at a pivotal moment. By focusing on high-value industries, leveraging policy incentives, and adopting a patient, strategic approach, investors can position themselves to benefit from the next phase of China's economic evolution. Thought-provoking question. Is China's FDI decline a warning sign or a strategic opportunity? Share your thoughts in the comments. Let's spark a discussion.